Are you happy with the tax return you got this year? If you've gotten one. If you haven't, maybe you still need to file your taxes, but you still have time. Were you happy with the one that you had last year? Could you get a larger refund? Are you required to pay all your taxes? As we approach tax season, numerous people get excited about receiving a tax return. Is this an investment? Could we get a larger return? How much interest did you get? None. Let's say you're a saver. If you make $1,000 per week and have to pay 30% in taxes, you'll take home about $700. And then let's say you set $100 aside in a long-term savings account. That leaves you with about $600 for bills and expenses, correct? You follow me? All right, let's say that you put that same money into a different account where you don't pay taxes on it. Could you save more money? Well, let me explain. You still make $1,000, but now you take out the $100 before taxes. You still have to pay taxes. Not 30% on $900 is $270. Then you subtract that out from after taxes. That leaves you with $630 for bills and expenses. Does that make sense? Could you do more with that money for take home, to pay bills and expenses, to do whatever? In the United States, individuals and entities, that's businesses or corporations or LLCs, sole proprietors, etc., that earn income are generally required to pay federal and state income taxes on their income. The exact tax liability, though, depends on several factors, including the type and amount of income, filing status, and number of dependents. In addition to income taxes, individuals and entities may also be required to pay other taxes, such as payroll, that's for Social Security and Medicare, sales tax, property tax, and estate tax, depending on your specific situations. It's important to consult with a tax professional, of course, or use tax software in preparation to determine your tax liability and comply with applicable tax laws and regulations. How much are you required to pay in taxes in the United States? Ever wonder why some people pay less taxes than maybe you? The amount of taxes you are required to pay in the United States depends on several factors. That includes income, filing status, and number of dependents. Did you know that you could increase your tax exemptions and raise your take-home pay too? It's legal, but not something that you want to do without some good advice. Because you could come back and end up having to pay more in taxes and it not maybe be a good time to do that. So, got to watch that one. Income taxes in the United States are levied by both the federal government and state governments. The federal income tax is a progressive tax, which means that the more you earn, the higher the tax rate will be. The tax rate ranges from 10% to 37% for the tax year 2021, and this year it's maybe the same or probably different. But anyway, did you catch that? The more you make, the more you pay. Well, of course. So why would you want to make more money? On the other hand, if you could reduce your taxable income, why wouldn't you? In addition to federal income taxes, you may also be required to pay state income tax, which vary depending on the state in which you live. Some states do not even have an income tax like Florida, while others have a flat tax rate or a tax rate that increases your income or with your income. There's also other taxes that you may have to pay, requiring like payroll taxes, Social Security and Medicare, sales tax, property tax, and estate tax. It's important to note that tax laws and rates are subject to change, and it's a good idea to consult with a tax professional or use tax preparation software to calculate your tax liability. The government is not going to tell you what you have to pay, much less how you can pay less. It gives you guidelines. Why? Ever heard the phrase, all donations are gladly accepted? Imagine a waitress saying something like, oh, my service was really poor. You got a 5-ounce steak instead of a 6. Or the owner got a discount on those potatoes, so you get a reduction. Really? That ever happened to you? Hasn't happened to me. All right then. What did Judge Learned Hand say about paying taxes? All right. Judge Learned Hand, a famous judge on the United States Courts of Appeal for the Second Circuit, is often quoted as saying, anyone, and that includes you, may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes. What? All this time I've been paying all those taxes and I could have made other arrangements? This quote highlights the idea that individuals have the right to arrange their financial affairs in a manner that minimizes their tax liability, as long as they comply with the applicable tax laws and regulations. At the same time, it also suggests that there is no obligation, hear me, to pay more taxes than is legally required. This quote has been widely cited and is often used to emphasize the importance of tax planning and the right of the individual to minimize their tax liability within the bounds of the law. How do you pay less taxes? There are several ways to potentially pay less taxes in the United States. And these include things such as maximize your tax advantage savings. Contributing to tax advantage savings accounts such as a 401k or an IRA can reduce your taxable income and lower your tax liability. You've heard of those, I'm sure. They're all over the news half the time or anywhere you go. You can also itemize your deductions. If you have significant deductible expenses, such as your mortgage interest if you own a home, charitable contributions, or medical expenses for seniors particularly, you may be able to itemize deductions on your tax return and reduce your taxable income. There's also tax advantages of tax credits if you're younger. The tax credits directly reduce the amount of taxes you owe and can be more valuable than deductions. But you have to qualify for those, as you know. Examples of tax credits include the child tax credit, the earned income tax credit, and the American Opportunity Tax Credit. If you own a business or self-employed, you could defer your income and have more control over when you receive that income if you have that control. You can defer that income to a future tax year. You may be in a lower tax bracket or have lower taxable income at that point, whichever benefits you. Consider your filing status. Your filing status can have a significant impact on your tax liability. For example, married couples may pay less by filing a joint return rather than separate returns. Also, review your withholdings. That's your exemptions. Making sure that the right amount of taxes are withheld from your paycheck can help you avoid an unexpected tax bill or penalties at the end of the year, and can also be, like I said earlier, used to perhaps lower your amount of or increase your amount to take home and thus give you more money to save. It's important to know that tax laws and rates are subject to change, and it's always good to have an idea to consult with a tax professional or use tax software in preparation to determine the best strategy for reducing your tax liability. Best tax advantages investments. The best tax advantage investment depends on your individual financial situation and your investment goals. However, here are some commonly used tax advantage investment options. Number one, you've heard me talk about it, traditional IRA. A traditional IRA is a tax-deferred investment account that allows you to contribute pre-tax dollars and defer paying taxes on the earnings until you withdraw the funds in retirement. Roth IRAs. The Roth IRA is a tax-free investment account allowing you to contribute after-tax dollars and withdraw the funds tax-free in retirement, as long as you meet certain conditions. 401ks. 401k is a tax-deferred retirement savings plan offered by many employers. Contributions are made pre-tax, and earnings grow tax-deferred until you withdraw the funds in retirement. Municipal bonds. These are bonds you get from the cities and projects in the cities. Municipal bonds are debt securities issued by state and local governments and are generally exempt from federal income tax. Health savings accounts, an HSA as it's nicknamed, is a tax-advantaged savings account that can be used to pay for qualified medical expenses. Contributions are made pre-tax, and withdrawals for qualified medical expenses are tax-free. It's important, again, to consider your individual financial situation and investment goals when choosing tax-advantaged investments. For example, if you expect to be in a higher tax bracket in retirement, a Roth IRA may be a better option than a traditional IRA. It's always a good idea, Ken, to speak with a financial advisor to determine the best tax-advantaged investment strategy for your individual needs. Fixed annuities wasn't mentioned in the list versus IRAs, but a fixed annuity and an individual IRA are two different types of retirement savings vehicles, each with its own unique features and benefits. A fixed annuity is a type of insurance contract that provides a guaranteed, steady stream of income during retirement. The income payments are based on a fixed interest rate and the amount of individual initial investment. Fixed annuities are typically sold by insurance companies and offer a guaranteed return on investment, making them a popular choice for those who want a low-risk investment option. An IRA, on the other hand, is a tax-advantaged savings account that is designed to help individuals save for retirement. IRAs come in two main types: a traditional IRA, as we talked about, and the Roth IRA, which we also talked about. Traditional IRAs offer tax-deferred growth of investments, meaning that taxes on the money invested and the earnings it generates are postponed until the funds are withdrawn. Roth IRAs offer tax-free withdrawals in retirement, but contributions are made with after-tax dollars. IRAs offer more investment options than annuities, including stocks, bonds, and mutual funds, allowing for a potentially higher return on investments. Again, I would check that out. When deciding between a fixed annuity and an IRA, it's important to consider your investment goals, your risk tolerance, and overall financial situation. If you're looking for a low-risk investment option with a guaranteed return, a fixed annuity may be the better choice. If you're willing to take on more investment risk for potential higher returns, an IRA may be a better option. It's always good, again, to speak to a financial advisor to determine the best retirement savings strategy for your individual needs. But it's a good thing to get started somewhere also. What tax advantages does life insurance have? Good question. Life insurance has several tax advantages that can make it an attractive component of a financial and estate planning strategy. I know, some of you don't even have the estate at this point, but hear me out. Some of the tax advantages of life insurance include death benefit. Okay, this may come important for children, if you have children. The death benefit paid to the beneficiaries of a life insurance policy is generally tax-free, which can help provide financial security for long loved ones in the event of a policyholder's death. I've often said, with all the shootings going on these days, it might be something to look at. Premiums are paid for life insurance are generally tax deductible, which can reduce the policyholder's taxable income. Cash value. Some life insurance policies, such as whole life and universal life, have a cash value component that grows tax deferred. This means that the policyholder can accumulate wealth over time without paying taxes on the growth of the cash value until the funds are withdrawn. Withdrawing those can be done in a couple of different ways, and again, it's a good idea to seek a professional. Estate planning. Life insurance can also be used as a tool for estate planning, as the death benefit can provide tax-free funds to pay estates, taxes, and other expenses. It's important to note that tax laws and regulations are subject to change, and the tax implications of life insurance can vary depending on the type of policy and the policyholder's individual circumstances. It's always a good idea to consult again with a tax professional or financial advisor to determine the tax implications of life insurance for your individual situation. And so I can't say that enough. Fixed indexed annuities is another vehicle. A fixed index annuity is a type of insurance contract that provides a guaranteed minimum interest rate and the potential for higher returns based on the performance of a tax market index, stock market index, such as the S&P 500. The annuity guarantees that the policyholder will receive at least a minimum rate of return, even if the underlying index performs poorly. With a fixed indexed annuity, the policyholder's investment grows tax deferred, meaning that taxes on the investment earnings are postponed until the funds are withdrawn. The policyholder can choose to receive a guaranteed stream of income in retirement, or they can choose to withdraw the funds in a lump sum or as a series of payments. Keep in mind, the taxable situation may be different later on, and you may not have to pay as high taxes when you take the money out and it's growing tax deferred. Fixed index annuities can be a good choice for those who want a low risk investment option for the potential of higher returns based on the performance of a stock market index as opposed to an individual stock. They are typically sold by insurance companies and offer a guaranteed return on investment, making them a popular choice for those who want to protect their retirement savings from a market volatility. It's important to note, again, as I've said before, that indexed annuities are complex financial products and come with a range of fees and charges, including surrender charges, if the policyholder decides to withdraw their funds before the end of a surrender period. It's also always a good idea, again, to consult with a financial advisor and carefully review the terms and conditions of a fixed indexed annuity before making a decision. If you didn't know some of this information, I understand. Hopefully this has been an awakening. If you did, perhaps this will mean a recommitment, some things to think about, some other opportunities out there to make money or save more money. So please feel free to request more information. We'll be glad to discuss solutions to your retirement needs or refer you to any of our knowledgeable contacts. Just click the link below, like, subscribe, and follow, and have a good day.